Have you ever thought about investing in real estate? It's a question that has crossed the minds of many. Why? Because it offers a plethora of opportunities to grow your wealth. Imagine owning a property that appreciates in value over time, providing you with a solid return on investment. Or perhaps you fancy the idea of earning a steady stream of rental income, providing you with financial stability and independence. That's the beauty of real estate investment. However, it's not as simple as it sounds. It requires understanding, careful planning, and strategic decision-making. That's where we come in. Our aim with this video is to demystify the complexities of real estate investment. We'll break it down into simple, understandable steps, guiding you through the process from start to finish. So if you've been considering investing in real estate, or you're just curious about the process, you're in the right place. Let's embark on this exciting journey together. Now, the first step to becoming a successful real estate investor is understanding what it actually means to invest in real estate. So let's break it down. When we talk about real estate investment, we're referring to the process of purchasing property with the intention of generating revenue. This revenue can come from two main sources: rental income and resale for profit. Let's start with rental income. This is the money you earn from tenants who are leasing your property. Whether it's a single-family home, an apartment complex, or a commercial building, the concept remains the same. You provide a space for your tenants to use, and in return, they pay you rent. Over time, this rent can add up to a substantial income stream, especially if you own multiple properties. Now let's talk about the second source of revenue: resale for profit. This involves buying a property, often one that's undervalued or in need of some TLC, improving it and then selling it for more than you paid. This is commonly referred to as flipping a property. It's a bit riskier than earning rental income, as it depends on the property's value increasing over time. However, the potential profits can be significant, making it an attractive option for many investors. But what types of properties can you invest in? Well, there are several categories to choose from. Residential properties include homes and apartments. Commercial properties can be office buildings, retail spaces, or even hotels. And then there's industrial properties like warehouses and factories. Each category has its own set of advantages and challenges, and the best choice for you will depend on your personal goals, skills, and risk tolerance. All right, now that we have a basic understanding of what real estate investment is, let's move on to the next step. The next step in the process is to evaluate the real estate market. But why is this so important, you may ask? Well, the state of the market can significantly influence property values and the potential returns on your investment. It's a bit like surfing. You want to catch the wave at just the right moment. Too early and you might miss the peak. Too late and you might find yourself swept away by the tide. So, how can you evaluate the real estate market effectively? One way is by researching local property prices and rental rates. This will give you a sense of what you can expect in terms of income if you plan to rent out the property. And it can also help you determine whether the asking price for a property is reasonable. You can find this information through online real estate platforms, local newspapers, or by talking to real estate agents and property managers. Another crucial aspect of market evaluation is studying market trends. Is the real estate market in the area growing, stagnant, or declining? Are property prices rising or falling? Understanding these trends can help you make informed predictions about how your investment might perform in the future. You can often find this information in real estate reports, economic forecasts, and news articles. And lastly, don't forget to consider broader economic factors. Interest rates, inflation, and the overall health of the economy can all have an impact on the real estate market. For example, when the economy is strong, more people are likely to buy homes, which can drive up property prices. Conversely, in a weak economy, property prices may fall, but rental demand could increase as fewer people are able to afford to buy their own homes. Remember, evaluating the market isn't about making perfect predictions. It's about gathering information to make informed decisions and manage risk. Just like in surfing, you can't control the waves, but you can learn to read them and choose the best time to ride. Once you have a good understanding of the market, you're ready to start looking for properties to invest in. The third step in the process is choosing the right property to invest in. Investing in real estate is not a game of chance, but a calculated decision-making process. So, how do you identify a good investment property? Let's dive into this. Firstly, location is key. You've probably heard the old adage, location, location, location. It's popular for a reason. The area where your property is located can significantly impact its value and potential for growth. Whether it's in a bustling city center, a peaceful suburb, or an up-and-coming neighborhood, the location should cater to the demographic you aim to attract. Next, the condition of the property is vital. A property in poor condition may require a significant investment in repairs and renovations, which can eat into your profits. On the other hand, a well-maintained property can command higher rents and attract quality tenants. It's essential to carry out a thorough inspection and, if possible, bring in a professional to identify any hidden issues. Potential rental income is another key factor to consider. Research comparable properties in the area to gauge the going rental rates. This will give you a ballpark figure of what you can expect to earn in rental income. Resale value is equally essential, especially if your investment strategy involves selling the property in the future. Look at the trends in the property market, the growth potential of the area, and the property's unique selling points. These factors can influence the property's resale value. Lastly, it's important to consider your own financial situation and investment goals. While real estate can be a lucrative investment, it's not without risks. You should only invest what you can afford to lose. Moreover, your investment goals should align with the type of property you choose. For instance, if your goal is to generate a steady income stream, then a rental property may be a suitable choice. Remember, every property is unique, and what works for one investor may not work for another. It's about finding the right property that matches your investment strategy and financial goals. Choosing the right property is crucial to your success as a real estate investor. The fourth step in the process is financing and purchasing the property. This is where your research, evaluations, and decisions culminate into action. You've found the right property, now it's time to secure the funding and make it yours. Let's start with financing options. Most investors rely on traditional mortgages, where a bank or lender provides the funds to buy the property, and you pay it back over a set period, typically 15 to 30 years. To qualify for a mortgage, you'll need a good credit score, stable income, and a down payment, usually around 20% of the property's value. But traditional isn't the only way to go. Creative financing can open up other avenues for investors. You might consider private loans, which can come from individuals or investment groups. They're more flexible than banks, but often carry higher interest rates. There's also seller financing, where the person selling the property agrees to lend you the money to buy it. This can be a great option if you have a good relationship with the seller or if traditional financing isn't available. Now, let's move on to the purchase process. It all begins with making an offer. This is where your negotiation skills come into play. You'll want to offer a price that's competitive but still leaves room for profits. Once the seller accepts your offer, you'll move into the closing process. This involves a lot of paperwork, inspections, and possibly more negotiations. It's during this time that you'll want to have a real estate attorney or a trusted advisor by your side to ensure all terms and conditions are in your favor. Remember, every step of this process is crucial. From choosing the right financing option to successfully negotiating the purchase price, each decision can impact your investment's success. Once you've purchased the property, you're now officially a real estate investor. Congratulations! This is just the beginning of your journey into the world of real estate investment. The final step in the process is managing the property. Now, this is where the rubber meets the road. Owning an investment property isn't just about signing the deed and letting the rent roll in. There are responsibilities to consider, like property maintenance, tenant management, and financial management. Think about property maintenance. It's essential to keep the property in good condition, not only to maintain its value, but also to attract and retain tenants. Then there's tenant management, which involves finding reliable tenants, setting fair rental prices, and handling issues that arise. And let's not forget financial management. You'll need to keep track of income and expenses, handle tax obligations, and ensure a positive cash flow. If all these tasks seem overwhelming, remember, you can hire a property manager. They can handle these responsibilities, allowing you to focus on the bigger picture. And there you have it, the basic steps to becoming a real estate investor.